Hi, everybody, and welcome back to video number 1 in Chapter 18. And here we're going to look at cost behavior and the cost volume profit analysis, often abbreviated CVP. And so as we look at this chapter, conceptually, we're going to describe different types of cost behavior and how they relate to production and sales volume. And then we'll take a look at several applications of cost volume profit analysis. This is a very good chapter for analyzing different kinds of outcomes based on volume. So we're going to be analyzing here the contribution margin and describing what it reveals about a company's cost structure. And then we're going to analyze the changes in sales using the degree of operating leverage. And lastly, under procedural, we'll estimate costs using a variety of techniques, the scatter diagram, the high-low method, and briefly into regression analysis. And then we'll compute break-even points for a single company. And we'll do that in terms of both sales and dollars, volume and dollars. And then we'll compute the break-even point for a multi-product company in a little more sophisticated application. Okay, and then finally in Appendix 18 Bravo, we'll compute unit cost and income under both absorption and variable costing. All right, let's look at describing different types of cost behavior in relation to production and sales volume. Managers use CVP analysis to make predictions. Number one here, how many units must we sell just to break even? And two, what sales volume is needed to earn a target income? And number three, how much will income change if we buy a new machine to reduce labor costs? And four, what is the change in income if selling prices decline and volume increases? And finally, how will income change if we change the sales mix of our products or services? These are often analyses which we as managers are asked to make, especially in a manufacturing environment. So first of all, let's look at fixed costs. As shown here, fixed costs stay the same no matter what level of volume you have. So here's our volume here on the x-axis, and here's our costs on the y-axis. And these are costs that don't change as volume changes. Unit fixed costs will decrease as volume increases. So in this case, I think you can see fixed costs would be things like rent on the building. We're going to have the same amount of rent every month. It doesn't matter if we make 1 unit or 100 units. But if we make 0 units and our rent's $10,000, right? It's still going to be a fixed $10,000. But if we divide that, we happen to make 1,000 units, then our fixed cost per unit would fall. All right. So variable costs change in proportion to volume changes. Unit variable costs will stay the same as volume changes. So if I make a little, show you here, a little plastic bottle, we're going to have, if we make 1 unit, we're going to have direct material, the resin that goes into that, and the label that goes on that, the blow molded machine that's used to make it, and the injection molding machine that's used to make the cap. all that is going to be the same for each bottle. So if we make 1,000,000 bottles and it costs us $1 per unit, it'll be $1,000,000. But if we make 1 unit, it'll be $1. Okay. Unit variable costs will stay the same as volume changes. So now let's look at graphing that. This is a nice little graph, I think, because here's our fixed costs. And on top of that, we're putting the variable costs here. They graph it here so that it's paralleled up here. Okay. And so if we look at the variable cost per unit, it's $20 per unit. But from the fixed cost perspective, the per unit fixed costs fall asymptotically as volume increases. Okay. So, of course, the world is not perfect, and we have mixed costs, which include both a portion that are fixed and a portion that is variable. And I like to use an example of a telephone line. There's a fixed cost on that telephone line every month, whether we use it or not, but also we would pay long distance charges to the degree that we use that phone line. So mixed costs is greater than zero when volume is zero. That's the fixed cost component, and increases steadily in proportion to increases in volume. That's the variable component. Okay. Now, stepwise costs are important to consider as well. They have a step pattern in costs within a relevant range. The relevant range here would be here, and then here, and then here. We might need to add another shift. We might need to add another plant. We might need to add more overtime. Okay, so the relevant range is the normal operating range for a business. Okay. All right, cost examples. Let's look at fixed costs. I mentioned rent, but we also have several others. Property tax, insurance, office salaries, depreciation. They asterisk that and say that's not 4 units of production. This would be just straight line depreciation. But variable costs, direct materials, like I used the resin in my bottle example, direct labor that we would use to put those bottles into production, the packaging that we had on the labeling for the bottle, shipping containers, the shipping costs, and some indirect materials that we use in the manufacturing process. Mixed costs here would be a sales rep. He gets a salary, but he also gets, or she gets, a commission. Natural gas. The more we make, the more natural gas we use, but we also use the natural gas for other purposes. Maintenance cost. Obviously, the more we make, the higher the maintenance. But to some degree, there's fixed charges there for the salaries of our maintenance workers. And then electricity, if our machines are using electricity, we use more when we make more, same with water. And then stepwise, here we add a shift, like I mentioned. Maybe we add a production line. Maybe we add or drop a warehouse. Maybe we add or drop a sales region. Okay, so let's estimate costs using the scatter diagram or high-low method and regression. Here, we're going to look at a CVP analysis and identify and measure cost using fixed and variable components. And how do we do that? we use three methods: a scatter diagram, a high-low method, or a regression analysis. Here we have a list of the units that we produced and the total costs. Here's the units that we produced and the total costs for the next 6 months. Now you can see that the units produced are different in each month. Here in December, for example, was our highest month at 67,500 units. And it looks like June was our lowest month. So the question remains, how do we estimate fixed and variable costs given that? Now, frankly, I think I'm pretty good with a ruler. And what I can do is lay these points of volume in here and the costs, and I can line this orange line up to be an estimated line of cost behavior. Sometimes I think I'm better using a ruler than I am using some of the more sophisticated techniques, because I can predict the future a little bit better than the analytical model might be able to do. Nevertheless, scatter diagrams are useful. Now, the high-low method, this one you'll need to know for your homework as well. So we need just 2 points to estimate the cost equation: the highest point and the lowest volume level. Notice that these units produced are the volumes. So if I'm going to pick the low, it's in June. If I'm going to pick the high, it's in November in terms of volume. So let's look at that. What I do, and here it's outlined in yellow, here's June and here's November. I take the highest cost at the highest volume, and that's going to be $31,000 here. And I'll subtract out the lowest cost, and that's going to be $18,500. That difference is $12,500. Then on the denominator, I take the highest volume, which is 67,500, and back out the lowest volume, which is 17,500. And so I take the 12,500 and I divide that by the difference between the highest and lowest volume of 50,000. And that gives me 25 cents per unit. Okay. So my equation then is total costs is equal to fixed costs plus variable costs. That 25 cents per unit is my variable cost. So here's my fixed, I know my total cost of 31,000 at the high point here. And I also know I don't know the fixed cost, but I can estimate the variable cost by taking 25 cents times the 67,500 units here. And that gives me $16,875. Now I can subtract $16,875 from $31,000 to get $14,125 of fixed costs. Now you'll notice that I did that on the highest volume. I can also do it on the lowest volume, which I'm doing here. Again, I come up with 17,500, which is my volume here, and my 18,500 is my total cost. So if I foot this out the same way that I did for the high, I come out with $4,375, which means, again, my fixed cost is $14,125. So now I can say my total cost is $14,125 plus 25 cents for every unit I produce. That looks like a good place to stop this video, and when we return, we'll continue on with regression.